Welcome to Self-Test 4.1 video. In this video, we're going to look at Karim Consultants. So let's call up my ink. So for Karim Consultant Private Limited, we are looking at for the year ended 31st December. And this year end is very important, especially as we come to a question like this regarding adjusting entries. So we are provided with 4 information here. And if you look at this 4 information, each of this information can be mapped to the 4 different types of adjusting entries that you have learned in this chapter. So I hope you are able to identify, but we will go through them one by one shortly. But firstly, let's look at the requirements. So firstly, we are supposed to do the adjusting entries, journal entries, yeah. Again, remember for the year ended 31st December. Secondly is to calculate the adjusted net profit for the year ended 31st December 2017. Why adjusted? Because before adjustment, the unadjusted net profit was 20,000. After these adjustments, these adjustment entries will affect this unadjusted net profit, and you have to revise it based on those adjusting entries. Hence, you get to derive the adjusted net profit. And last but not least, in part C, we will ask what if these adjustments are not recorded. Let's look at the impact on all these things, whether it's overstated or understated by those adjusting entries. Alright, so with that introduction, shall we begin then? So let me erase some of these markings. Okay, let's begin with the very first one. Let me split the screen so that I can easily scroll to the journal entries. Alright, first up, utilities expense of 5,000 for December 2017 has not been accrued. Remember, the adjusting entries are all at the end of the financial year. In this case, is December 31st, 2017. So when it says utility expense has not been accrued, what it means is that the accrual for utility expense has not been recorded. And what does accrued, what is utilities expense? It's expense, right? So accrued, so this therefore must be an accrued expense scenario, whereby the expense has been incurred. That's why we need to record the expense by debiting it. And accrued means it has not been paid. Paid means we owe means we should create a payable account for it. So since it's regarding utilities, so we should credit utilities payable 5,000. So can you see, expense include, debit expense, utilities expense, and we owe this expense, so we don't credit cash, but instead we credit the utilities payable. For the amount, it's very straightforward because we are told it's 5,000, so there's nothing to calculate other than just recording the amount given to us. So there you go, this is how you record an accrued expense. Next, we look at advertising expense. In this case, advertising expense of 16,000 was paid already and recorded on 1st November, and it was recorded as prepaid advertising expense. So on 1st November, when it was recorded, think with me, what do you think the entry was? Entry must have been debit prepaid advertising expense, $16,000, and credit cash, right? $16,000. But that was the business transaction that took place on 1st November. Now we want to calculate what is the advertising expense as of 31st December. So we need to put through an adjusting entry. Now to do that, we got to work out what is the amount of prepaid advertising expense that has become advertising expense by the end of the 31st December. So count with me, from 1st November to 31st December, how many months have transpired or taken place? So you got to be good at practicing your naming of your months, right, from January all the way to December. So in this case, is whole month of November because it started on 1st November, and whole month of December because it ends end of December. So November and December is how many months? 2 months. So 2 months of prepaid has become an expense. So if that's the case, we need to reduce prepaid advertising expense. So to reduce prepaid is to credit, right? because prepaid advertising expense is by nature an asset. So let me take my stylus pen. So this is a asset. So to reduce an asset, remember, is to credit. So we credit prepaid advertising expense. There you go, credit prepaid advertising expense. And this amount that is credited would become an expense, right? The 2 months. So to record an expense, we always debit. Okay? Debit advertising expense. And what's the amount to debit and credit? Well, 16,000 that was prepaid on 1st November relates to how many months? 1st November to 28th February. So that will be November, December, January, February. 4 months. So if 4 months is 16,000, 2 months must be half of the amount, right? So I repeat, 4 months, 16,000. So 2 months must be half of the amount, which is 16 divided by 2, $8,000. And there you go. You record the $8,000. Are we so far so good? Now again, if you cannot remember the debits and credits, by now you should be proficient in it since we are now into chapter 4. But nevertheless, if you still need to write out the information of the double entry, please proceed to do so. And to revise, let me write here, okay? So A equals L plus OE. Remember, anything to increase here is to debit. Over here, to increase it is to credit. Expenses and revenue fall into those left hand. So expenses behave like assets, whereby to increase is debit, and revenue behaves like liability and OE, whereby to increase is credit. So if you ever forget the double entryism, just keep writing them until you're so good at it you do not need to refer to them anymore. Now let's move on to information number 3. Here we have a consultancy fee for the month of December amounting to 7,000, which has not been received nor recorded. So unlike the first two examples, can you see it relates to expenses? This part 3 relates to, must be related to fee, right? Because it says, sorry, we must relate to revenue, right? Because it says it has not been received. So it's something to receive, so obviously it must be a revenue, because when you perform consultancy work, and after all, can you see here, they are Karim consultants, so their main source of revenue should be providing consultancy, and therefore the fee they earn will be consultancy fee. So the month of December looks like have been performed but has not been received, so this falls under the classic accrued revenue scenario, where revenue has been earned but have not been received. So remember, for revenue, R, when you earn means you increase it. To increase it, you credit, right? So you credit the revenue account, which is consultancy fee, 7,000. But have you received the money? No. So which means the person owes you, the client. So to record the account whereby the consultancy fee is owing to us is to create a receivable consultancy fee account. Alright, so you debit it by 7,000 because it's an asset. Asset to increase is debit. Now, let's look at information number 4. Consultancy fee of $12,000. Again, it relates to consultancy fee, and you can see now in this case, unlike the number 3, you have received it on 1st October in advance. Which means even though you've not done the work yet, you receive this fee in advance, and you record the entire amount in unearned consultancy fee. So what would be the double entry on 1st October? It would have been debit cash because you received the money, 12,000, and credit unearned consultancy fee. And unearned consultancy fee is a liability, right? Why? Because you still owe these fees which for the cash you receive in advance. And these fees that you receive in advance is for the period 1st October to 31st January. And how many months is that? October, November, December, January. 4 months worth of fee that you receive in advance. But that was on 1st October. But come the end of the financial year, which is in the case of 31st December 2017, how many months have taken place since then? Well, if you count with me, it's October, November, December. So that will be 3 months. So out of the 4 months that you receive in advance on 1st October, by 31st December 2017, you would have received 3 months. Or rather, it's not received, but rather the unearned, or rather now you can record in your books 3 months of consultancy fee that you have earned. So 3 months of consultancy fee out of 4 months of 12,000, how much would that be? Well, just take 3 divided by 4 times 12,000, and that will give you 9,000 that you see here. So you debit 9,000, credit 9,000. And which account to debit and credit? Well, remember unearned consultants fee is a liability, so liability is always credit in nature, right? So now since it's earned, you got to reduce this account by 9,000. So to reduce a liability is to do the opposite of credit, which is debit. So you debit, first row is always debit, unearned consultancy fee 9,000, and then you recognize it as revenue. In this case, it's consultancy fee. So in other words, you debit unearned consultancy fee 9,000 to reduce the liability, and then you record the revenue, which is consultancy fee $9,000. So there you go. That's how you record the 4 information and in terms of the adjusting entry. Yeah. So to recap, the first one is about accrued expenses, expense incurred but you owe. Second one is to recognize the prepaid that has now been or recognize the prepaid expenses has now been incurred. So the expenses incurred is you debit the expense and credit the prepaid. Then the third adjusting entry is to recognize accrued revenue, whereby revenue is earned, so you credit, and you haven't received the money, so you debit the receivable. And the fourth one is to reduce the unearned consultancy fee and transfer it to the revenue account. So you debit the unearned consultancy fee and credit the consultancy fee. Good. So with that, let us now work out the unadjusted net profit. Now to do that, I'm going to use the 2 screen again. So I'm going to scroll down here to the adjusting entries to put it up there, and down here I'll put the workings for the adjusted net profit. So remember in the question earlier on, we began with the unadjusted figure, which is the 20,000. Yeah, remember? Here is 20,000, the unadjusted. So we start with the unadjusted amount, right, of 20,000. So oops, again it runs, no worries. Go to pens, pen, and there we go, 20,000. And then we look at the adjusting entries up there. So we need to identify all the expense and revenue accounts, or rather in this case all the revenue expense account, because only revenue and expense accounts will affect the net profit. Remember? So let's look at them one by one. The first journal entry, there's an expense account here, right? So this expense 5,000, and then here another expense 8,000. So 2 expense accounts. So when you have expense accounts, it will increase or decrease profit. It will reduce, right? That's why you minus the 2 expense accounts. Whereas the third and fourth journal entry, notice it increases revenue. There's a credit to consultancy fee twice. So revenue has increased, so revenue will increase or decrease net profit. Revenue will always increase, right? That's why it's a plus 7,000 and plus 9,000. So once you account for the expenses, the expenses here and the revenue, you'll get the updated net profit, which is the adjusted net profit, and the amount should be 23,000. You should get that amount. Well, at least now you know how to get it if you've got it wrong. But if you got it, well done. Now in part C, we are asked to look at the impact of the adjustments if they were not recorded on the revenue, expenses, net profit, assets, liabilities, and shareholders' equity. So now let's look at each one of them in turn. So let's begin with the impact of omitting these adjusting entries on revenue. So if you look with me, the accounts that relates to revenue should be which one? should be adjusting entry number 3 and 4, right? Because can you see consultancy fee? So these two are revenue, and these two accounts were credited. So when you credit revenue, it is to, can you remember? If not, scroll up. To increase revenue is always to credit, or to credit revenue is always means to increase it. So since you were meant to increase it, and if you omit it, you did not increase it, so revenue therefore will be a lower figure. Lower figure means revenue is understated. By how much? Take the 7 and the 9. Take the 7 and 9 and you get 16k. Alright? Now let's move on to the expenses. So again, look at the adjusting entry. Looks like adjusting entry 1 and 2 relates to expenses, and you're supposed to debit these two expense account. So to debit means to increase the expenses. So since you didn't increase the expenses, you would have understated the expenses, right? Understated by 13,000. Because to debit an expense means to increase, yeah? If you can't remember, let's scroll up again. There you see, expense to increase is debit. Alright, then let's move on to net profit. Now when it comes to part 3, if you remember, net profit is a result of essentially taking your revenue minusing your expense. And you have already worked out the impact on revenue expenses in part 1 and part 2. And we stated that in revenue, we have understated it by 16k. And expenses, we have understated it by 13k. Now let's look at each one of them to see their impact on net profit. So if revenue is understated means you recorded less revenue. From there you can see from this equation the direct impact would be net profit will be less also, right, by 16k. And therefore net profit will be understated by 16k. How about expenses? If expenses is understated by 13k, means you're minusing a smaller figure, what will happen to net profit? You'll get a result of overstating your net profit, right? Because you minus a lesser figure, you get a higher figure. So understated 13k of expenses will result in a overstated net profit of 13k. So on one hand you have understated 16k, on the other hand you have overstated 13k. The net impact would be understated of 13 or 3k rather. Can? That's why the answer is understated by 3k. Make sense? Alright, if that is the case, you can actually now jump to number 6. Oops, what happened to my number 6? Alright, now so my assets, my net profit would have a direct correlation to shareholders' equity. Why? Can you remember earlier on in the early chapters, your net profit will always be transferred to your retained earnings, and in turn retained earnings will fall under shareholders' equity, right? So if your net profit increase, your retained earnings will increase, and therefore your shareholders' equity will also increase. If it's a decrease, it has the same direct correlation. So in this case, net profit is understated by 3k. So if net profit is understated by 3k, retained earnings also will be understated by 3k, and therefore shareholders' equity will also be understated by 3k. There you go. So always, if you come to this question, do 3 and 6 together, or rather net profit and shareholders' equity together. Then let's move on to the last two, assets and liabilities. So if you look up here, out of these 4 adjusting entries, where are the assets? I can see 2, right? First one is prepaid advertising expense, because prepaid advertising expense is an asset because you are prepaying something. So the person owes you this service, right? The advertising service. So that's why it's the asset. Here you credit. Now to credit asset means what? Increase or decrease? Decrease, right? Because remember, if you look at the double entry system, asset to increase is debit. So if you credit means you decrease. So you're meant to decrease the asset, but at the same time, if you look at adjusting entry number 3, consultancy fee receivable is also an asset. you debit. Debit means increase. So on one hand you reduce an asset, on the other hand you increase. The net impact is an overall decrease of 1k. So you're meant to decrease it by 1k, but you didn't. You omit the adjusting entry, so your asset will be overstated by 1k. Okay, then let's move on to liabilities. For liabilities, again there are two entries here. Yep, sorry, two accounts that relates to liability. One is utilities payable, the other is unearned consultancy fee. Utilities payable, credit means increase or decrease, and you credit a liability. Well, remember, liability to increase is always credit. So credit means increase, whereas here the liability you debit means you decrease. So overall you would have decreased liability by 4k. So you're meant to decrease it, but you didn't. So which means you overstate, right? Your liabilities by 4k. There you go. Okay. So with that, we have come to the end of this explanation on part C and on self-test 4.1. I hope it has been helpful, and so happy learning.